And thank you for joining us today for the game-changing market update. I'm Jeff Carbone, certified financial planner, managing partner at Cornerstone Wealth. As always, joined by my partner, our chief investment officer and chartered financial analyst, Cliff Hodge. Hello, Cliff.
Hey, Jeff. Great to be with you. And thank you, everyone, for dialing in today.
Well, Cliff, with our game-changing market update, we've got the NHL, the NBA in the midst of playoffs. We've got baseball started just a few weeks back. So the game-changing events we're going to talk about today, maybe not athletically talking about, but game-changing nevertheless. I know you're going to go over the Cornerstone dashboard, the signaling, and of course, the playbook we have in place at this time. I know we'll also go over and discuss Silicon Valley Bank and the banking situation, what happened, what the Fed may have in store, upcoming meeting just a few next week. Recession, no recession, where are we going? We'll discuss that. Again, as always, a fair amount of information to go over today. Of course, reach out to your advisor, the advisory team here at Cornerstone. We can certainly be of further assistance if you want to discuss any of the topics further or have some questions. Also, welcome to a few new team members here at Cornerstone. We want to welcome Matt and Aaron. So if you get a chance to speak to either of them, give them a big welcome on behalf of the clients. As we begin to dive in, just a quick reminder, we're recording our session today to be available on our website, our Facebook page, our YouTube channel. Anything else Ashley can find for us to post, we're going to post it. If you do get an email following up in a couple days, again, feel free to share it, send it along to friends, family, colleagues if they have questions or want to know kind of what we're thinking. We'd love to hear some thoughts from them. Our goal and mission, as always, as your trusted advisors, to provide clarity and confidence as the cornerstone of your financial life. So, Cliff, I'm going to push it over to you, and I'm going to let you share the agenda because I know there's pretty packed. So I'm going to let you start diving in.
Thanks, Jeff. And thanks again, everyone, for joining us today for the second quarter market overview. We've got some slides ready. So today we'll take a brief moment to review what's happened so far year to date before we begin to turn our expectations for the rest of the year, really driven by our dashboard and the three key pillars of our investment process, which, just to review briefly, are the macroeconomics, fundamental, and behavioral analysis. Also happy to introduce a new feature, Cornerstone's asset allocation framework and positioning guidance that we will finish up with on the call today. And so also, as Jeff mentioned, happy to take any questions or talk about any recent developments in the markets. So with that, we'll get started. And we're going to lead off with just some of the key takeaways from what we're seeing in the markets. On the positive side, we are seeing some signs that inflation is beginning to slow down. That's fantastic. That has been the public enemy number one of the Fed. So happy to see that we are making some progress with slowing inflation. However, our models and our process are indicating that the U.S. is in late cycle from a business cycle standpoint and heading toward a recession, really with just timing kind of being the major question at this point. Whether or not it's going to be late 2023 or early 2024. And as always, the labor market. So what's happening in the jobs market is really going to be the key driver for the inflation timeline. Secondly, the Fed is nearing the end of the tightening cycle, which again is another positive sign. Though the fallout from Silicon Valley Bank and some of the other regionals that have gotten themselves into a little bit of trouble is likely going to continue to be a drag on liquidity, credit growth, and then ultimately the growth of the economy. Though that's unknown at this point. That is something that we're certainly going to be keeping an eye on here over the coming weeks, months, and quarters. Last but not least, these, again, going through the steps in our research process leads us to remain defensively positioned. Certainly not yet the time to get aggressive from a risk-taking standpoint. So what that means in practice is that we do favor bonds and alternatives over stocks. So when we talk about what's happened so far year to date, markets are off to a nice start for the year. The S&P is up a little over 7, NASDAQ up over 17, though a lot of that has been driven by PE multiple expansion, as we'll talk about here momentarily. Bonds are up 3, and then the 60-40 portfolio is up roughly 6 after being down 19 last year. Again, the worst year on record for the 60-40. A couple of the major themes that we've been watching and tracking so far in 2023, it's been a pretty significant rotation below the surface, as last year's losers are this year's winners. And we'll kind of show what that means here momentarily. But a lot of that has been driven again by PE multiple expansion. So that's certainly a little bit of a warning sign for us, something that we're going to continue to monitor. The banking panic, we've got even a little bit more of that today with some poor earnings results from First Republic. Have had some questions about what that means for markets. Are we looking at a 2008 style credit event? Right now, the answer to that question is no. And then last but not least, we've started to get some questions on the debt ceiling. Judging from the tax receipts numbers that are continuing to roll in, it is looking more and more like it's going to be a June or July event. So we probably have a little bit of time before that becomes front and center for the markets. And we didn't prepare any slides on that today, but happy to dive into more specifics if there are questions. From our perspective, really the key takeaway is that politicians are going to do what politicians typically do: wait till the very last moment and then find a way to kick the can down the road for at least a couple of quarters, if not a year. Though I will say, the sooner we get to the lid of the debt ceiling, if it happens to come in June rather than July or August, I think that will actually be positive for markets, because it gives these guys less time to posture and ultimately make a decision. So that's kind of what we're looking for on the debt ceiling front. But again, happy to answer any questions on that as we go through. So as I mentioned, markets are off to a pretty favorable start for the year, especially if you look at some of the more growthy sectors of the market. Growth stocks, the most positive factor year to date, led by communications and technology. You look at which last year's losers are now the leaders of the market, whereas last year's winners, especially energy, utilities, and equity income. So I'll show here on the next slide. Energy, utilities, equity income were last year's losers, or I'm sorry, last year's winners, now 2023 losers. So there has been quite a bit of rotation here below the surface. Came across this chart for technology. I think it does a great job explaining exactly what has happened in equity markets year to date. As you can see, the black line here is the price to earnings ratio. So you just take the price of the stock divided by the earnings. That gives you this PE multiple. Earnings in blue, as you can see, earnings have steadily continued to fall, especially as we come into 2023, whereas the PE multiples are rising. So that's really a sign of optimism or a sign of hope from investors, but does call into question the sustainability of the rally that we've experienced so far. So I got a little bit of feedback on this chart. It's very busy. I know there are a lot of squiggly lines on here, but I kept it in really for one important reason. So what we did was we looked back at Fed tightening cycles going back to 1953. There have been exactly 13 tightening cycles. So of the 13, 10 of them, the market, the S&P 500, has bottomed after the last rate hike, with only 3 pretty rare exceptions was when the markets bottomed before the last rate hike. And so this is important because if you think about where we are today, roughly 4,000 and change on the S&P 500, and then you think about where the prior bottom was in this most recent cycle, was back in October of 2022, closer to 3,500. That's about a 15% gap between where we are today and the quote unquote most recent bottom of the S&P 500. And so this is important because if the historical pattern does hold, it is likely, and if we go into recession, it is likely, again, that we are going to either retest or potentially take those lows out in the S&P 500. So yeah, just another reason why we continue to favor bonds and alternatives over equities. Not that you ever want to completely sell out of your stocks by any means. We are certainly taking precautions to keep our clients positioned defensively in the equity space. But just again, to kind of point out some of the probabilities that we deal with as investors. There's no certainty, unfortunately. And so what we do is we align our investors to the most probable outcome and take every precaution that we can to make sure that we protect your wealth and that we're able to compound it again over time. So let's take a moment now and just talk a little bit about what's going on with the banks and the most recent banking episode. And we've gotten quite a few questions as to whether or not what we're seeing with Silicon Valley Bank, Signature Bank, First Republic is really the setup for a 2008 style global financial crisis. The good news is that the short answer there is no. In fact, the most recent episode is more closely tied to the savings and loan issues in the early 80s and in the 90s than 2008. Because what we're really dealing with today is an asset liability mismatch, not a credit event. So it's important to remember that banks borrow at the short end, that's the deposits here on the left. And then they can do one of two things with those deposits. They either lend them out or they buy securities. And in the wake of Dodd-Frank and the increased regulation post the GFC, global financial crisis, banks are really only allowed to invest in very high quality government-backed assets, i.e. treasuries and some mortgage-backed bonds. So as you can see on the left, these banks had just incredible deposit growth in the wake of COVID and the pandemic stimulus. SVB deposits were up 5x. You look at Signature Bank, First Republic, more than double. And there was not a commensurate pickup in loan demand. And so what did these banks do? Well, they went out and bought treasuries. The problem is, again, just remembering that they borrow in the short term, invest in the long term, is that they loaded up on long-term government debt. And as we all remember, the price of bonds and interest rates move inversely. So as interest rates were low, they loaded up on long-term debt to get a little bit of an incremental pickup in yield to help with their margins and their profitability. Much like the concept of picking up pennies in front of a steamroller. Unfortunately, steamroller in this case being the Fed. The Fed embarked on their tightening cycle. Interest rates, across the economy, across the world, increased. When that happened, it lowered the value of those bonds that they're holding on their books, as you can see here on the right-hand side, and exacerbated by a bank run, especially at Silicon Valley Bank and Signature. When clients demanded their deposits back, banks were forced to sell those bonds at a loss, even though if they were to hold them to maturity, they would in fact get 100 cents back on the dollar. The fact that the deposit run started required them to sell those bonds, and then that ate through the entire equity in the balance sheets, and then thus these banks were taken over into receivership. So really more of a bank management issue, not a credit issue and not a systemic issue. Why do we say that? Because if it were a systemic issue and if it were a credit issue, we would see leading indicators like delinquencies really begin to shoot up. So that's what this is a chart of here. Loan delinquency rates, going back almost 40 years. You can see where we are now as of March of 2023, very negligible, right? So it's a great sign that it's not a credit event. That's the good news. But what we are still parsing through is the downstream impacts on how much lending standards are going to tighten, and then what happens to the availability of credit. No question it's going to slow, and Jeff, there's really no question that it's going to continue to be a bit of a drag around the neck of the economy going forward.
Well, Cliff, again, lot of information there you're sharing, but a couple of things that maybe, again, the volatility is not gone, right? We don't give it, the coast is clear, and we'll share that in just a few minutes on why. I like the sectors that you were showing. The winners last year are the losers of 2023 so far, and the losers of 2022 are henceforth so far the winners in the early part of this year. So again, just things rotate and change so quickly. Thanks for the insight on the bank issue. I know we've had, as advisors, we've had quite a few calls and discussions. Thanks for putting out the piece back in March when we saw this happening. So appreciate your thoughts on that, that this is, again, remaining not a 2008, 2009 situation. So Cliff, why don't we move along into the dashboard and why we still remain in a more defensive stance from what we're seeing and what the investment process that you employ is showing us.
Yeah, absolutely. So we just did a review, rear view mirror, if you will, on what's happened year to date. So now we'll kind of turn the page and look forward. And the way that we do that and the way that we manage that is through our dashboard. So as our clients now are aware, there are really three key pillars to our process, and they are encapsulated here in the dashboard. That's the macro, the fundamental, and the behavioral. And again, it's just a quick reminder, what we're looking for here is alignment among these three key pillars. And just eyeballing the dashboard here, there unfortunately right now is a lot more yellow and red than there are greens. And so we'll walk through each of these briefly, starting with the macro. We'll look at the business cycle, the quads, what's going on with the Fed from a liquidity standpoint, then move on to the fundamentals, starting with valuations and earnings. We're right in the middle of earnings season, so we'll give a brief update on that. And then lastly, finish up with the positioning. And really, this is the only green that we're seeing on the screen right now is institutions are underweight, though that is being offset a bit by the retail crowd. So let's start with the business cycle. Again, this is the long-term representation of how an economy ebbs and flows over time. As you can see here highlighted in the blue circle, the U.S. is firmly in late cycle and heading toward recession. So some of the telltale signs, we're seeing growth both from an economic and an earnings perspective begin to moderate. Credit, no question, is tightening and is likely to be exacerbated from the fallout from the regional banking issues. Fiscal policies is continuing to be contractionary, monetary policy contractionary as well. Really, the major sign that we're looking for to mark the start of a recession is going to be around the labor market. And so far, labor is continuing to hold up extremely well. The unemployment rate is still 3.5%, so we're at the lows. Though we are beginning to see some evidence of cracks in the labor market if you look at things like job openings and hiring plans. Why is this important? If you look on the right-hand side here, this is 70 years worth of market data. The recession is this darker green color here. Really, the only time you do not want to own stocks is in recession. What do you want to own? Bonds, cash, and alternatives. So again, just thinking about the process and the alignment, starting with the business cycle, we continue to be in the risk-off phase. So then we turn to the quads. So I like to think about the business cycle as our map and the quads as a GPS to help us navigate the day-to-day, if you will. And what we look at here is year-over-year changes in GDP growth on the y-axis, year-over-year changes in inflation on the x-axis. And what we see right now is at least 2 more quarters of quad 4, where both economic growth and inflation decelerate simultaneously. Again, these are historically the quad 4 is the worst regime for risk assets. However, typically is one of the better, if not best, regimes for fixed income. So again, that's kind of 2 data points within our broader process that point to risk off in equities and then high quality positioning in bonds. I'll call out quads 3 and 4 here. I'm sorry, quarters 3 and 4 here. Right now, they are very close to the origin. As data comes in, these things are going to move around a lot. I sometimes get some questions about the outer quarters and what we're expecting. We'll have to see. But if we follow along the trajectory of the economy that I think we will, it's likely that these are going to continue to fall down into quad 4 over time. But we'll certainly be keeping an eye on it, and certainly let the data continue to guide us. The last piece of the macro is what's going on with the Fed. So the left-hand side, we've got the federal funds rate, which is their policy rate, which they set overnight. If you look just back a year ago, we were at 25 basis points. Fed hikes affect the economy with long and variable lags, to quote the famous economist Milton Friedman. Typically takes about 12 to 18 months to really feed through the system. So if that is the case, we were at 25, 50 basis points a year ago. We're now at 5, with the market projecting another 25 basis points at the Fed meeting next week. We are likely to continue to feel these tightening effects through the coming quarters as we move through time here in our economy. The right-hand side is a liquidity proxy. So not only does the Fed control monetary policy through interest rate hikes, but they also will employ their balance sheet via quantitative easing or quantitative tightening. That's what this green line tracks: changes in Fed liquidity. And why this is important is because, as you can see, there's a very high correlation between Fed liquidity and the S&P 500 here, which is the blue line. This is roughly 2.5, 3 years worth of data. We got a rush of liquidity injected into the system from the Fed post SVB with the lending programs and some of the things they were doing. No surprise there that the markets reacted in kind. Well, now that green line has begun to roll over, liquidity is going to get pulled from the system as long as they keep doing QT. And ultimately, we think markets are likely going to continue to follow that path. So again, when you consider the macro, business cycle, quads, Fed, doesn't look good for stocks at this point. Does, however, continue to favor bonds and alts. So then step 2, phase 2 of our dashboard are fundamentals. And with fundamentals, we always start with valuation. So we look at price to earnings ratios. Again, just gives us a range for how expensive or how cheap markets have been relative to the past 10 years. You can see the S&P 500 here, not really cheap, not really expensive, but certainly not extremely attractive by any point. However, there are areas of the markets that are looking attractive, especially when you think about in the U.S. value stocks, especially compared to growth. Relatively cheap. So we do have some more value oriented names in our portfolios. You look at ex-US, also cheap relative to the S&P and relative to their own histories. International developed emerging markets all looking more and more interesting. And so we are starting to overweight against some of those areas of the market. When you look at a sector perspective, a couple of things that stand out. Energy continues to be really cheap, though it's historically not a sector that you want to be overweight going into a recession. So we are roughly at market weight within our energy stocks across the board, but we'll be looking to keep those on a tight leash. Areas that we are overweight, that we are interested in: healthcare. Again, a little bit of a discount relative to the S&P. Same thing with utilities, average valuations, more defensive. And consumer staples are the other area where we're at least market weight on a more defensive basis. So we are underweight things like financials, things like industrials, things like materials, these more cyclical areas of the market that we'll want to be buying those at the depths of a recession, not going into one. So that's the view on the equity side. On the bond side, even though rates have come in just a little bit here over the past few weeks, still attractive relative to their long-term history. Again, we're kind of concentrating on this left side here, higher quality. So things that have, government guarantees, or that be treasuries, mortgage-backed bonds, or investment grade, high quality corporates can kind of get that 4 to 5% range. And we are complementing those with a little bit of emerging markets on the offense side, so to say, because you can get a little bit of a higher yield, a little bit of enhancement to the overall portfolio, and pretty reasonable valuation. When you look at the credit spreads, which again is just the difference between the interest rate on the bond and the interest rate on the commensurate treasury. High yield has pretty interesting starting yields right now. The spreads are tight. This is an area that we're going to be watching very closely, because in recession, on average, this spread blows out to 8% over treasuries. That's when we're going to be looking to get more aggressive, when these green dots begin to move a little bit higher. Again, just not the time, in our opinion, to start looking for those. We want to see, those spreads really move out, those valuations get cheap, and panic, frankly, in some areas of the market. We look for that as buying opportunities. Like Warren Buffett said, you want to be buying when there's blood in the streets. Currently, we're not seeing that, which is positive. So then the last bit of the fundamental stool are earnings. We're about a quarter of the way through. 123 companies have reported. Sales growth is up 6 year over year. Earnings growth is down 2. That sales growth is benefiting from inflation, as companies are continuing to be able to raise pricing. However, what we're seeing is that from an operating leverage standpoint, the growth in costs are outpacing the growth in pricing. So we've seen that with wages, cost of materials, so on and so forth. So we continue to expect that earnings will be weak as inflation rolls over and prices start to come down. We should see that the weakness in earnings actually accelerate. And so, what you can see here on the right-hand side is that there's just a massive disconnect between consensus estimates for the economy. Right now we're roughly 1.5–2% expected for 1Q. That's going to get released on Thursday. But then you look out all the way into 4Q 2023, basically flat, more or less recessionary at that point from a GDP estimate. But then you contrast that with earnings estimates from the street, and you've got 5% year-over-year growth for 3Q, 10% year-over-year growth for 4Q. That's just not really a world that we live in, where these two things can coexist. And so our bet, again, based on our process and what we're seeing, is that these earnings estimates are going to continue to come down and perhaps likely even contract, which again is not a reason to go out and buy a bunch of stocks. Lastly, we'll hit on behavioral before we hit on positioning, and then I'll turn it back over to Jeff and we'll take some questions. But again, really the only green on the screen on the dashboard is here with our institutional positioning. We're able to track what large asset managers, hedge funds are doing with their futures and options positions. Most underweight the S&P and the Dow really over the last 10 years. So institutions are underweight, not fully invested. So when it will become time for them to buy, that's going to push your prices up higher. Though I will say in this case, to offset that a little bit on the retail side, which are just the average investors, they have been in greed mode. So retail is fully invested. Institutions are underweight, and so they kind of cancel each other out a little bit. But again, what would get us excited is institutions, continuing to be underweight, options markets really blowing out to the upside here, and then retail feeling extreme fear. Again, that's the setup from a behavioral standpoint that would get us excited about adding risk. But again, just not quite there yet. Last slide. This is something that we've been working on quite a bit, and I'm really excited to roll this out more broadly. We'll be updating these on the webinars, and we'll share these more frequently as we update them. But this is Cornerstone's newly revealed asset allocation guidance. And so what we're looking at here are three major asset classes: equities, fixed income, alternatives, and then where we are on a scale, right? So neutral kind of being right down the middle, underweight, overweight. So as you can see, we're a little bit underweight equities, overweight fixed income and alternatives. Fixed income continues to be the highest conviction asset allocation decision for us in 2023. But here you can also see within each major asset class which areas we like better than others. So for equities, as an example, we favor defensives, value, international. Again, that's going to line up by and large with the multiples and the valuation fundamental part of our process. Underweight small caps and really overweight tactical. We like the ability to be nimble and introduce exposures that may not necessarily go up in line with the S&P. Within fixed income, again, high quality. So the treasuries, as I mentioned, mortgage-backed, investment-grade corporates, EM we like as well. Underweight things like leveraged loans and high yield that are more credit plays. Again, going into a recession, we want high quality and remain defensive. And we would look to be adding these types of exposures at the depths of a recession, if and when that day comes. Lastly, same deal for alternatives. There are things that we favor, like relative value and arbitrage kinds of plays. Much less interested in owning private equity, private credit, things of that nature at this point. And so with that, I will just review our key takeaways and then hand it here back to Jeff. So again, we are seeing some signs that what the Fed is doing is working. It is slowing inflation, though it is likely going to send the economy into recession. Watching the labor market very closely for timing on that. We are getting near the end of the tightening cycle. What we're trying to parse out is ultimately, how much of an effect the lending, higher lending standards, tougher lending standards, and slower credit growth is going to be a drag on the economy, likely to continue to remain volatility in the markets as we move through the year and get more data. And then we want to remain defensively positioned. Got a little tongue-tied there. It's not the time to get aggressive with risk-taking. We favor bonds and alternatives over equities. So with that, Jeff, I will stop sharing my screen and I will turn it back to you.
Oh, thanks, Cliff. Again, a lot of information. Thank you for sharing. Thanks for taking the time to put this together and be there and share the information with everyone on the call today and everyone that will get the email or has a chance to review it on their own time. Again, thanks on behalf of the whole investment team. I know following the process, right, is key. And we say planning, process, and patience remains the 3 Ps within the Cornerstone environment that we're all here and as a team for you. I'm going to summarize your summary, Cliff. We saw that renewed, and as we said, Q1 plus since we're in April, right? Maybe the renewed optimism amongst the bout of fears that we've seen, the lingering uncertainty, right? What we've seen all sides of the volatility so far. We went from the recession fears in March to soft landing, hard land. We're all over the place. The instability of Silicon Valley and the banking issue, shows how quickly market dynamics change. It's also a good reminder of the importance of a balanced portfolio that our clients have. We continue to employ, again, the process that you put together for us all to follow. It's also a good reminder of how resilient the U.S. economy remains. Among the elevated inflation we're dealing with and the concerns of the financial instability, the puzzle the Fed's trying to put together, the markets have continued to move forward, but we remain, again, more concerned about what could happen, and hence we remain in a more defensive position to weather through the financial storms that could arise, should they arise, right? We also have to remember the 2020s, not the roaring 20s of the 1920s. I don't know that, but the 2020s are unlikely to resemble the 2010s, where markets were dealing with low inflation, lower interest rates. We're in the higher inflation, higher interest rates for longer. It adds more volatility. It adds more sector dispersion and a bit of additional degree of uncertainty. So with all of that, again, the key, some key reminders as the investment team and from the managers that we choose to employ in other areas, right? Favoring high quality investments that are resilient across the environments that we're in. As you mentioned also, Cliff, we're going to look to find dislocations that are occurring and look for those opportunities and really target returns, from our alternative assets and alternative portfolio that are also uncorrelated to the broad markets, but deliver those risk-adjusted returns. So, as we close out, one thing that I noticed from the planning side and the wealth management side, we've had quite a few clients retire so far in 2023. Certainly more than 2022 and 2021 as we came out of the COVID world that we were in. But congratulations to everyone that has made that step into retirement. We wish you all well. You know who you are. Made me think for a few minutes. And for those if you're already retired or not yet retired, time to plan for what's the biggest retirement challenge we've seen or I've seen. I've been doing this 32 years now. The biggest retirement challenge is not what one may think is financial. It's actually the emotional retirement challenge. And that challenge is really replacing the social connections or the social interactions that we have with our fellow coworkers that we've worked with for so many years. So maybe we start to think a little different and prepare a little differently. You prepare more on an emotional side of planning for retirement. So think differently in terms of not what are you retiring from, but what are you going to retire to? And what I mean is, how are you going to replace those social interactions? Are you going to volunteer? What hobbies do you enjoy playing golf? And you have the golf league that you're part of, or the tennis league that you're part of. Are you going to travel? Who are you going to travel with? And we were with some clients today that have their travel partners. And they go with anywhere from 2 to 6 other couples on traveling. So they have their interaction there. Are there family or friends that you just haven't been able to connect with because of time, working, whatever it may be? So again, the team at Cornerstone, we're here as with our clients all the time, discussing, going over how we can be that cornerstone in their financial life. But we also want you to know we're also here to discuss the emotional side of retirement at any time. And just let us know how we can help and what we can do to help you with that. On behalf of the Cornerstone team, Cliff, thanks for your time. We thank you for joining us today. We appreciate the trust and confidence you continue to place in Cornerstone. As you know, it's never taken lightly. We appreciate working for each of you. Keep an eye out for that replay email that Ashley will be sending. Send it or share it with your friends and family, colleagues that could also be of some assistance. If we can, let us know how we can do so. As always,
Jeff, before we sign off, a late question did come in.
I was going to say thanks, Cliff. I didn't see any questions come through, so I apologize.
Yeah, I've got it here. I can read it. Here's the question. Some pundits have said the unemployment rate is a depression era metric and not valid, given that there are 7 to 10 million able-bodied workers who have left the workforce and are sitting on the sidelines. Your thoughts on this? Great question. It's really been a bit of an anomaly with what we're seeing on the unemployment rate. I will say that from our perspective and for our process, it's not just the unemployment rate that we track from a metric standpoint. There are really, quite a few different metrics that we look at. So things like the percentage of the population that's in the labor force. The inverse of that is the labor force participation rate. So we monitor that. We monitor jobless claims, right? So the percentage of the population or the count of folks that are applying for jobs unemployment assistance, both on an initial basis and on a continuing basis. We look at also a lot of survey data. Most importantly for us, we don't necessarily care about the level of the unemployment rate. What we care about more so is the rate of change, right? And so even if a 3.5% statistic is not a great number, just given some of the dynamics that you asked about, what we're watching for is how that number is going to change, right? So in the past, it may have been, you start at a 4% unemployment rate level and you get up to 6 or 8. This time we're starting at 3.5, and as long as they don't change the goalposts on us going forward, then we will be able to see how that change will affect the economy, and that's what they're going to use in order to call it a recession. So hopefully that answers the question.
Cliff, I don't know if you saw, there was another one from William that came in about maybe we talked about the Silicon Valley banking issue. I think William's question is regarding the potential for the commercial real estate pullback. I don't know if we say crash. He said crash. Well, due to the we're seeing lower occupancy rates. I'm sure a lot of folks saw the article about New York in terms. I think it was a 40% occupant, or it could have been. I know it was in the 40% occupancy. So maybe a little bit of thoughts on that as well.
Yeah, so I mentioned during the presentation that so far the SVB fallout is an asset liability problem and not a credit problem. I think commercial real estate is where we potentially could see a credit problem. Now, commercial real estate in general, there's various segments, right? So multifamily being one, office, retail, so on and so forth. We are most concerned about office, right? Jeff, you mentioned that the occupancy rate in New York is low and does not seem to be picking up. I think nationally, there's roughly a 20 to 25% vacancy rate in office. And so what are the ramifications going to be if people don't fully go back to the office or fully move back to the large cities? So that is office and commercial real estate are definitely an area that we're watching closely. In talking to some real estate professionals and professional investors that just specialize in real estate, there does appear to be a temporary glut of supply in multifamily coming on later this year, especially in hot cities like Austin, Nashville, perhaps even Charlotte, where what we'd be looking for then in that space is if you start hearing more and more about forced selling. That would actually get us really excited because structurally we are underhoused. We just, from the fallout of the GFC, we just did not keep pace with population growth, especially in areas where people are migrating. So we would look at multifamily commercial real estate, at the end of the year going into 2024 as a pretty fantastic opportunity that we will want to take advantage of there.
Thanks, Cliff. We had one more, but Michael, I'm going to say that's more of a planning question. That's more of an individual. And Michael was just asked, when can he look to begin drawing down on one's portfolio, I'm assuming, and while minimizing taxes? Again, that's really more of a personal discussion with your advisor. I always say it's not what you have, it's how you spend. So again, a lot of those questions, the rule of thumb is again somewhere in that 4% withdrawal rate, and sometimes we go higher. But there's a lot behind that, Michael. So that's more, maybe take that off line with the advisor as well. But thanks everyone for listening and joining us today. Again, thanks Cliff and the investment team for putting all this together. A lot of hard work, I know. Again, we thank everyone for joining us. As always, we want to wish you health, wealth, and happiness in the coming months ahead, and we will see you all soon. Thanks, everyone.